Welcome to The Explainer. Today we're diving into a stock that has become a true battleground for investors, Rezolve AI. We're going to break down the powerful forces that are trying to send it to the moon and the incredible pressure that's trying to hold it down.
So, have you ever wondered what creates one of these perfect storms? Where there's this intense, crazy interest in one single company from both sides, the bulls and the bears. What's the actual recipe for a high-stakes showdown like this?
Well, when you look at Rezolve AI, the story has a potent mix of these four factors, and each one adds another layer of complexity, another layer of potential fireworks. Let's dig into how they all connect to create this really unique situation. All right, so here's how we're going to break it all down. We'll start with what the company actually does, then get into the valuation, check out the market signals, and then we'll look at that explosive short interest factor before we wrap up with what to watch for next.
Okay, first things first. To really get this story, you have to understand the business itself. So let's take a look at what Rezolve is all about, and its big push into something the industry is calling agentic commerce.
So, agentic commerce, what the heck is that, right? Well, Rezolve is aiming to be a leader in this whole new area, and they're doing it by building an AI specifically for retail. Now, this is the really key part. It's designed not to make stuff up or hallucinate. And for any business that's going to rely on AI to make money, that is a huge deal.
And listen, this wasn't some overnight thing. They spent more than 9 years deep in research and development before they even started showing up at these huge retail conferences. And that 3 to 6 month sales cycle, that's super important. It means they have a pretty good idea of what new contracts, what new revenue is coming down the pike.
Okay, so that's the tech. Now let's talk about the money, which is our second key ingredient. And this is where things start to get really interesting and a little controversial.
And boom, right here, this chart pretty much shows you the heart of the entire debate. You've got Wall Street analysts saying, maybe 170 million in revenue. But then you have Rezolve itself guiding for more than double that, 350 million. This huge gap is a massive part of the story.
So get this. Even with the company telling everyone they're aiming for $350 million, the entire company is only valued at around $1.2 billion. Now, if you actually believe their numbers, that makes its price-to-sales ratio look really low. And for a tech company that's growing like a weed, that's a huge flashing green light for some investors.
To really get why people are so divided on this undervalued idea, you've got to know there are two main ways to look at a company like this. You have the super conservative analyst method called discounted cash flow. But for these hyper-growth tech stocks, a lot of investors prefer the price-to-sales ratio. And believe me, based on the company's own guidance, it tells a completely different story. And that valuation debate leads directly to this idea, which you hear tossed around a lot. This quote really nails the bullish argument. The basic thinking is, hey, this company might be a takeover target. For a giant player, the technology alone could be worth way more than what the whole company is valued at right now.
Okay, on to our third ingredient. Forget the company's own numbers for a second. A ton of the attention here is coming from what the so-called smart money is doing. Let's follow the big institutional cash.
We're seeing some serious activity from sophisticated traders, especially over in the options market. And look, these aren't your average, everyday retail trades. We're talking about large, institutional-sized bets that pretty much scream a strong belief that this stock has a lot of room to run.
I mean, just look at this chart. It's pretty one-sided, wouldn't you say? Out of more than $1.5 million in recent big options trades, an insane 97% have been bullish. That means they're betting the stock is going up. That's not a trend. That's practically a stampede.
And hey, it's not just the options traders. Even the normally cautious, buttoned-up Wall Street analysts see some major upside. Their average price target is over $9.50, which, from where the stock has been trading, is more than a 100% jump.
All right, now for the fourth and final piece of this puzzle. And honestly, this is the ingredient that could pour gasoline on the whole fire. The massive number of people betting against the stock, the short sellers. 31%. Just let that sink in. That is an incredibly high number. It means that almost 1/3 of the company's shares that are available to trade are being used to bet that the company is going to fail. And to put that percentage into real terms, we're talking about over 38 million shares. When you think about how many shares trade on an average day, that is a ton of stock that would have to be bought back in the open market for these traders to get out of their bet.
But here's what's really wild. This isn't some old bet. The number of short sellers has absolutely exploded. going from just 5.5% in late November to over 30% today. That kind of rapid pile-on is exactly why this stock is on everybody's radar right now.
And this is what creates the classic short squeeze scenario. It's like a coiled spring. If any good news comes out, or if buying just pushes the stock up, the short sellers start losing a lot of money. They're forced to buy shares to stop the bleeding, but that buying just pushes the price higher, which forces more shorts to buy. You see where this is going? It can create a massive chain reaction.
So you've got the fundamental growth story, you've got the big money betting on it, and you've got this massive short position all coiled up. So what are the key things to watch for? What could be the spark that sets it all off?
Well, a lot of traders see this as a series of dominoes. The first domino to fall would be a technical breakout. The next would be pushing past that big psychological $5 level. If that happens, that's when the shorts could really start to feel the pain, and that could trigger that third and biggest domino, a cascade of them all trying to buy back their shares at once.
And there are actually a few things on the horizon that could act as that spark. There's a Supreme Court ruling coming up. You have earnings from other tech companies that could lift the whole sector. More positive news could come out of that big retail conference. Or heck, it could just be more and more investors catching on to this story.
So when you put it all together, you have this incredibly compelling situation. You've got a strong growth story clashing with a massive bet that it's all going to fail. It really leaves us with one final provocative question. When you have forces this powerful all converging on one single stock, isn't a dramatic move, one way or the other, almost inevitable?